Hello, guys, and welcome to part two. In part two, we are going to break down the contract. We're going to talk about the Greeks, but let's begin with the contract breakdown. In part one, closely at the end, we're looking at ETARP. Let me go back to that one. We were looking at this stock, and I was showing you what where you can find the call, the put, the bid, the ask, and the strike price on here in the option chain. This is called an option chain, and today we're going to break down the contract. Okay, so I have screenshotted the same stock, which is ETAP, and I have screenshotted different expiration dates. Okay, so we have the 16th April, then we have the 21st May, and then we have the June 18th. And if we look at all these expiration dates, we see that the call is the same. So we went for the $4. Okay, so we went for the $4, and at May we went for the $4 call, April $4 call, and June $4 call. But now let's look at let's break it down. April 16th, $4 call is equals. When we go for that, we will have to pay 90 how do you say 90 $89 okay, so we would have to pay $89. If we look at the strike price is 4, and the ask price here is 0.89. So 0.89, in the last episode we talked about it. One contract equals to 100 shares, so we have to multiply these by 100. So it will cost me to buy April 16th contract for $4 call. I will have to pay $89. When we go to May, for the same call, we would have to pay 105. The premium price changes. It's not anymore 0.89, but it's now 1.05. So that equals to $105. When we move to June, we see that the call is the same, again $4, but the price is still the premium price is still more than April. So what does this shows us? Here it will, for June 18th, it will be $95. What does this tells us? The closer the expiration date is, the higher the risk is. So it means that it is cheaper to buy a contract. The further the expiration date is, the less riskier it becomes. And so the more it costs to get in a contract. Okay, so we have to be very, very careful when it comes to when we choose an expiration date, which is a little bit further. We have to remember that the further it is, the more we have to pay for the contract. Okay, because when the expiration date is a little bit closer, it is riskier. Just imagine when you go into a shop and you want to buy a bottle of milk, you will definitely want to choose something which is a little bit further, right? Yes, that's the same thing. They expect us to choose something which is less riskier. That's why it is more expensive. Okay, so the closer the contract is, the expiration date is, the less riskier, the more riskier it is. That's why it is cheaper than buying an expiry date which is a little bit further, which is less riskier but more expensive. Okay, so let's go to the next slide. In the money and out the money. When we look here, we see an orange line I think this one is a little bit better. We see an orange line with a small orange file on it showing ITM. I think you may not be able to see it, but it is written ITM. And ITM, the file shows up. It means that, let me go back to it. This is in the money and out the money. So when we look at this example, we have the strike price here. This is the strike price, and everything below the 4.5 is in the money. At the same time, this is the call, right? So everything that is below the 4.5 is in the money. When it comes to the sell, as when it comes to puts, everything below the everything above the 4.5, which is starts with a 5, is going to be in the money. Okay, because when we go for a call, we are expecting it to go up. So the share price, which is above the actual share price, which is 4.5 or 4, is going to be out the money. Okay, when it's above the 4.5, which is above the actual share price, is going to be out the money. Any ITM, any strike price currently under the share price. So the share price is 4.5 right now. So anything below this share price, the 4.5, is going to be in the money. Everything above the 4.5 is going to be out the money. Any strike price above the current above the current share price. So normally you should always choose a strike price which is closer to the in the money. You can choose in the money, but it's going to be a little bit more expensive because it's easier to reach. But if you expect the price to go to 5.5, for example, and you know that this is out the money, it's going to cost you 0.05, which is just $5. So it means that you can choose this one. Okay, but because you're expecting it. So even if the price goes to 5, you can still profit. Okay, you can still profit. The price doesn't have to reach the 5.5 for us to be able to be profitable. That's why in the next segment, when we go to the Greeks, you understand why. But this is in the money and out the money. In the money is any strike price currently under the share price, and out the money is any strike price above the current share price. Okay, so let's go to the next one, the next slide. And this is IV, implied volatility. Implied volatility. Please remember this. Just as you should remember or know these basics of an options contract, the call, the put, the bid, the ask, and the strike price. Also in the money, ITM and OTM, in the money and out the money. You should remember and memorize this because it is very, very important, and also important for your success, okay, as an options trader. Implied volatility, IV, mostly shorted with IV. I think okay, it's not placed here, although yeah, we can see it here on the right side. Under volumes, you can see implied IV is right now 55.6%. Okay, it always shows you. So now let's go to it. What is IV? A measure of uncertainty regarding the seller of an options contract. A measure of uncertainty regarding the seller of an options contract. What you need to know about IV? If the IV percentage of an options contract is high, that means you are buying that particular contract at a higher price. This also means that the specific contract doesn't have much room to grow, which comes to your profit, which will affect your profit. Doesn't have much room to grow in value anymore, but instead more room to drop. So it's also an indication for us, okay, if it doesn't have much room to grow, then it doesn't make sense for me to enter this contract, because why would I enter something where I will not be able to benefit? All right. So It is an indication which we need to look into before we buy a contract. As you can see here, this contract ETAP was at 55.6%. That is just half. We still have room to grow. So maybe if the IV will be at, let's say, 83, 84, 85%, then I'll come to think about, okay, should I really enter this contract right now? That doesn't make sense because the room to grow is not there. So why should I enter and go and risk losing my investment? Okay, so you have to really use IV. You have to really understand what IV is, and I'll recommend you to go back, listen again, read it again, and understand what IV is. Same as in the money and out the money, because these are also very important to understand what kind of effect they have on us. Now, let's go to the Greeks. Greeks are very important because they have an effect on your gains. Let me put it this way. They have an effect on your gains. So let's go to the first Greek. The first Greek is delta, which is very important. Big impact on an options value. Estimate how much an options contract will increase per $1 move. Can also be used to measure the probability of a contract expiring in the money. You want this to be as high as possible and always higher than the other Greeks. The delta is very important to us, and it has to always be the highest, okay, among the Greeks. The delta has the power to increase, decrease, depending on the movement of a stock. So don't just buy a contract. You have to also observe how your contract is moving, how it is performing. That's why you have to be vigilant, okay? The delta is very important. It's the most important Greek, and we have to make sure that it's always has the higher number, okay? It's the highest, okay? We have to be very careful. The second one is gamma, used to determine the rate of change of the delta. We want this to be the second highest Greek. Example, premium price is $1. The delta is 0.50 and the gamma is 0.05. So the delta is the highest. We want it to be the highest. The gamma, we want it to be the second highest Greek, because the gamma is also a positive Greek for us next to the delta. So these two, we will equal these two, okay? We'll equal. We will add the gamma to the delta. So it means that for every dollar move of the premium price, we will add 0.55 $0.55, okay, $0.55, because we will add the gamma to the delta, which will give us $0.55. Okay, so we will add this to the premium price. So this is the gain of every dollar move that we will receive. Okay, this is the gain of every dollar move that we will receive. So that will be 55 cents or whatever currency you use. So in this case, it will be $0.55 per contract move. Now let's come to the third Greek. Theta tells you how much value is taken away from an options contract with each passing day, time decay. We want this number to be as low as possible. Example, the premium price is $1, right? When we added the gamma and the delta, we got here in this example an additional of 55 cents, right? So we'll have $1.55, right? So when the delta comes in play, it means that we will each day that passes, we will subtract 0.03 per day. Okay, that is why it's important that you want your data to be as low as possible, and definitely not above the gamma, or definitely not above the delta. Okay, so you want it to be as low as possible. If possible, sometimes it may be higher than the gamma. Yeah, okay, sometimes it can be higher than the gamma. That is not bad, but it shouldn't never be higher than the delta. And if that is the case, you definitely shouldn't go for that contract. So the Tether per day, 0.03 dollars will be subtracted from the $1. So if we start today, we buy the contract today. Tomorrow, the $1 will only be 97 cents, for example, 97 cents. Okay, 0.97. Okay, the next day. So additional day, we have to. So the second day, there will also be another subtraction. So that will be 0.94. Okay, so each day that passes, theta is theta is subtracted from the premium. Okay, so that is why we want the delta to be the highest, gamma to be more. It's better to be the second highest. Okay, so that we have the 55. So in addition to this, we'll have $1.55. $1.55. So when the theta is minus, this is 0.03, then we'll have we'll have the next day, we will have $1.52 instead of 55. The following day, we'll have another additional subtraction of 0.03. Okay, so this is what the Greeks are. Again, the Greeks, you want the delta to be the highest, the gamma to be the second highest, the theta to be the lowest. Okay, it should be the lowest number possible. Okay, and let's go to open interest. Open interest, the amount of active contracts that have not been exercised, closed, or expired. The more, the better. You want this number to always be as high as possible. Okay, you want this to be as high as possible. As it says, it's the amount of active contracts that have not been exercised, closed, or expired. So when you go for, let's look here into the option chain. When you go for April 16, for example, you want the open interest to be as high as possible. Okay, you want it to be as high as possible for these contract that you want to choose. Okay, but you can also place the open interest here. You see here we have the volume, the delta, the bid, and the ask price, the strike price. You can add another column, which is the open interest, and you can see that. Okay, when we go to the IB in this course, when we use the IB Interactive Brokers to show you some of the strategies that I use, then I'll come back to the open interest and show you how you can indicate that. So the open interest. Now, kindly, let's go back and review everything. We had a contract breakdown. We talked about a different contract. The further a contract is, the expiration date is, the higher the price is. Okay, because the further the expiration date is, it is less riskier. When the expiration date is closer, it is riskier. That's why the prices are lesser. That's why you have here, you see in this example, April is $89, May is $105, and June is $95. The further the price is, the further the expiration date is, it becomes much more expensive. Okay, I don't want this I don't want part 2 to be too long, so let's go through. In the money, we had in the money and out the money. Any strike price, ITM in the money, any strike price currently under the share price and we have out the money, any strike price currently above the share price. Okay, so this is it. And then we have the implied volatility, which is IV. It measures if the IV percentage of an options contract is high, that means you are buying that particular contract at a higher price. This also means that the specific contract doesn't have much room to grow up in value anymore. Instead more room to drop. So the higher the IV is, it is not recommendable to trade that. So if you have a percentage of maybe 80, the IV is 80%, then I'll not recommend you to go into that contract because the risk is too high that it may drop. Then we have the Greeks, we have the delta, the gamma, and theta. Delta is what you need or you want to always be the highest number. Okay, then you have the gamma. This gamma is a number that you want to be second and not third, second, because we have theta, and theta is something, it's a Greek that you want to have the lowest number when possible. Thank you for watching part 2. I hope you enjoyed. Don't forget, the next episode is coming where we'll be talking about indicators, different indicators, and other topics. So move straight to part 3 and watch that episode. Thank you for your time. And thank you also for booking this course. Don't forget, you can always book a one-on-one, a personal one-on-one with me. 15 minutes is free. Book that and let's have a conversation on what you can improve on, what you want to do. If you have any questions, feel free to DM me. Also, subscribe to my YouTube channel. Don't forget, and trade safe. Don't be greedy. Trade with a plan. Okay, trade with a plan and don't be greedy. And let's be profitable. See you in the next episode.